Well, hello there, everyone. This is Bruce at Fleet Capital Management. It's Friday afternoon, the 19th day of September, 2025. We're going to take a look at the market. We're going to continue with our series of taking a short look at the economy and what some different charts are showing us. And since we just had an interest rate decrease, I'm going to show you some statistics on that. So let's just jump right in. We always start by saying the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You can always email me, Bruce at fleetcapitalmanagement.com, and I will respond as quickly as I possibly can. We've been talking about the weakness that I perceive in the economy that I'm not sure is talked about on the news as much as I think it should be. You may or may not heard of this guy, Ray Dalio. Ray is one of the top hedge fund managers in U.S. history. I think more importantly than that, he's one of the great thinkers in America, especially when it comes to economics. And he has an amazing grasp of very, very long-term history. He has been advising, he's been shouting from the rooftops that the US debt is unsustainable, that it cannot continue on the trajectory that it has. It will crumble the economy. Today, he came out, and this is not brand new, he's been saying this for a long time. He urged investors to diversify their assets with around 10% of their portfolio in gold. And he says that gold and non-fiat currencies, what does that mean? A currency, a fiat, is like our money supply in the United States or in Europe. It is a country-controlled monetary system or means of currency. So non-fiat means gold, is probably the most. And you could also put Bitcoin in there. Uh, it would be a stretch, but maybe you could put Ethereum because Ethereum will be the platform on which stablecoins are built, and that would be a non-fiat currency. But I would encourage you, if you're interested in the history of economics and why the US debt is now unsustainable, feel free to Google this guy. Hundreds of articles will come up. If you'd rather, you can go to YouTube and put in his name and you can just listen to lectures. They're not the most exciting things in the world, but the man has a brain that is absolutely extraordinary. But anyway, he's saying that our economy cannot handle our debt. I agree with that. One thing that Warren Buffett recently said, and I shared with you a few months ago, I believe, is Warren Buffett said, if America was a company, you would never invest in them. Let that sink in for a second. If America was a company, you would never invest in them because they don't even have enough revenue to cover their debt. They're basically, the company would be considered insolvent. Um, so this is serious business. There are so many ways to look at the economy. This one popped up on Bloomberg today. It said US heavy truck sales and the business cycle. And wherever you see these gray shaded areas, those are recessions. And what this is suggesting is that when heavy truck sales start to fall, that's usually, nothing is always, a precursor to a recession. And here, the heavy truck sales started to fall, recession. Here, it was falling, short-term recession. Here we are now, it's falling. So there are a number of different indicators that are pointing to potential, I hate to say probable, recession. It could happen. Like I said, unfortunately in finance, nothing is black and white. There's just too many ways to analyze the data. But there's a lot of data. If we were to say over the road trucking is slowing down, well, those are the folks who deliver the products to the stores. They're going to slow down if the stores aren't ordering. So that's kind of how you think about this. Another way to look at it, and this kind of combines both the weakness in the economy and the rise of the dollar, along with the tariffs. The US dollar has fallen like a rock. And it is now at one of its lowest levels in, I'm not sure how long, but a very decades. And why is this happening? And it fell more this year in 2025 than it has at any time. It was a steeper fall. And they're saying it's because of the tariffs and the debt. And this is just that the value of our dollar just keeps dropping. We need countries from around the world to buy treasuries to support the dollar. Right now, that's not happening. We seem to have become a place that they don't want to buy. So, in any event, that's just another look at it. And then a fourth one is looking to see if what is happening in America is happening everywhere else. And the answer is no. This is the Chinese yuan to the US dollar. So it's comparing them. And the first name is what the chart is built on relative to the second name, which is US dollar. And you can see that the Chinese yuan is very close to an all-time high. So its strength relative to the US dollar is very significant. Their exports are going up. Their economy has been growing. And since the tariffs took place, our former trading partners from all corners of the world have been leaving the United States and creating trade deals with China. So the point of this is that it's not like the whole world is going into a recession or the whole world currency is weak. It's not. It's that the US is. And we are currently, unfortunately, the outlier. So this is not a global recession. We've had those before. That's not what's taking place here. The Federal Reserve the other day cut interest rates by a quarter of a point. I think that was the right move. I also wrote about this in an aftermarket email that hopefully you read. I listened to Chairman Powell's entire speech and Q&A after the decision, and I am so very impressed with him. I think he did a great job. And on this particular presser that he gave, I felt like he was the most transparent and gave the most complete answers that I have maybe ever heard. I was very, very impressed. He basically said, we have a problem. We, the Fed, have been put into a box. And I've been talking about this for 9 months. We have a weakening economy. And what the Fed does when we have a weakening economy is they lower interest rates. We have strengthening, growing inflation. What the Federal Reserve does when we have inflation is they raise interest rates. Well, we have both. And that's called stagflation. And that's a very bad position for an economy, for a country, for the Federal Reserve to be put in. Very bad. And I was leaning towards that he shouldn't cut rates because I believe the inflation from the tariffs have not kicked in fully yet. I think they will the fourth quarter, October, November, December. I've been saying that all year. But what he explained was that the inflation simply due to tariffs theoretically will be a one-time inflation punch rather than a systemic long-term inflation just keeps rising. He feels that it'll be more of a one punch type of a thing, but he felt that the weakening of the economy, especially the labor market, presented a greater risk than the one-time inflation hit from tariffs. That was his explanation. It makes all the sense in the world. I don't know if he's right or not. He doesn't know if he's right or not. He even said, I can't tell you what this is going to look like in 3 months. He said, I can't tell you because we're in somewhat uncharted waters. He really was fantastic. If you go to YouTube and you put in Chairman Powell rate cut decision September, that speech will probably come up if you're interested and would like to watch that. What this chart is showing is the S&P 500 returns. And remember, we just call the S&P 500 the market. Whenever we say the market, this is what we mean. And we were looking back on this study as to what happens after the first rate cut. So, year of first rate cut. That's what we just had. We had the first rate cut. And if you look at this 3 months after, a lot of times the market has been down. It's averaged down about 1%. But after 6 months, it's averaged being up 4.4, and after 1 year, up 4.9. Don't take these numbers as anything other than averages. Because as you can see, in 2001, 6 months after the rate cut, we were down 12.4%. But in 1998, we were up 26.5%. So this is just looking at a number of different years after the first rate cut. If you wonder why they're not in numerical order, we went from 2001, 2007, 2019, because 2019 would be the year that rates were decreased the first time. They were probably increased or left stable in these years. So that's why it looks like that. Okay. Lastly, some of you have suggested Bitcoin. We've been in Bitcoin, in and out of Bitcoin about 5 times, I think, and we've been profitable every single time. And we are profitable this time. But we've had a good deal of weakness in Bitcoin. And whenever that happens, I'll get an email or two, always welcome, that says, "What do you think? What do you think about Bitcoin? Should we leave and take our profits? What should we do?" And I use statistical analysis that leads to probabilities. You look at statistics, statistics are from history. Statistics are from history. You can't have future statistics. You have historical statistics, and then when they cross the today line, they become probabilities. Okay? So I look at a lot of this stuff, and you see these little smiley faces. They don't mean to be smiley faces. It's kind of a cute little picture. What this is it's called a reverse head and shoulders. It's just a term that's used for this type of a pattern. This would be the head, here would be the two shoulders, and this dashed line in is what we call the neckline in technical analysis. When the price forms a pattern like this, now right now it's below the neckline. You can see the hash mark is right over here. When it breaks that neckline, it generally it generally goes up a distance equal to the distance it was down from the neckline, if that makes sense. So there are a lot of indicators or indications that Bitcoin is going to continue to rise. And if we go back to what Ray said, Ray felt that more and more of the world's investment dollars are going to move into non-fiat currencies, non-paper currencies, not non-government controlled currencies, but things like gold, silver, Bitcoin, non-fiat currencies. And that statement also supports this chart. So you're never just trading off of one piece of information. You want what we call a confluence of multiple data points. It does not mean you're going to be right all the time, but it means you've raised your probabilities a significant amount. So I'm holding on to Bitcoin. I don't think it's time to sell yet, but when it is, we'll get out. And then, just like before, we'll get right back in if things change. So, as you know, the most important thing to know is whether the market's going up or down. Everything follows from there. And as you also know, we don't use opinions as to whether the market is going up or down. We use data from the market to tell us if the market is going up or down currently today, because we can't project tomorrow. Okay. So if we go over to our matrix, and some of you watching this may be new, I did another lecture in Arizona a couple of days ago, and it was on behavioral finance, a little bit more of how we make decisions on investments rather than the nuances of investments. But if some of you are joining us, you've never seen this before, so I will just very quickly say these two sections right here are based on a daily chart. Everything is based on the S&P 500. These two sections here are off of a weekly chart. again based on the S&P 500. And then what I'm looking at is the same, both on the daily and the weekly chart. I'm looking at volume and momentum. And then you've got volume and momentum. And then I'm looking at some moving averages, very short-term moving averages. And this whole chart is built pretty much on a stoplight, green, yellow, red. I think we've got one other color in there. But for the most part, it's green, yellow, or red. And green, when you have green on the daily and green on the weekly, and our moving averages, when the 3-day moving average is higher than the 20-day moving average, and that's higher than the 50-day moving average, that is a pure bullish configuration. And so what you have to do when you see this is your bias needs to be bullish based on what the chart is saying. And then we have something here, which is a weekly, 10-week, and 20-week exponential moving average. So it's a different type of a moving average. That's all it is. And this section here is what we call our bear market avoidance indicator. This can be either green or red. That's it. When the 10-week is above the 20-week, we have little to no risk right now of moving into a bear market. When the 10-week is below the 20-week and this turns red, we are on extreme heightened alert for a bear market and probably getting out of our securities and moving towards cash. So this doesn't mean we're in a bear market. This is how we avoid getting into or participating in a bear market. And then this section is called the VIX. It's the volatility index or the fear index. And all you need to know right now is if it's 17 or below, it's green, because that's a very bullish part of this index. If it's 17.01 up to 20, that's caution, and that's all it means is it's caution, because it can go from bullish to cautious to bullish. Sometimes it'll go to cautious. There was a ruling that came out on that day, a tariff ruling, and that's what caused this. If we go to 20 or above and this turns red, that is not a very smart time to be in the market. We don't exit completely, but we raise and tighten our stops, which are our protective measures, significantly. Okay, so that was a very brief overview. If you're new to this and you have questions about it, feel free to hop on my Zoom calendar, which I'll show you how to do, and I can explain it in greater detail. Let's go over to the charts, because the charts are really the most important thing. And let's go back to the S&P 500. On the left side, each line represents one day. So this last line is today. And on the right side, it's a weekly chart. Each line represents 1 week of trading, Monday through Friday. So this is this week. But we'll start on the daily. And you can see that the 2-week moving, excuse me, let me back up. The 3-day moving average, which is in white, is above that blue moving average, which is the 20-day moving average, and that's above the gold moving average, which is the 50-day moving average. So that's exactly what I said. That's called a bullish configuration, and our bias is to the upside. Today, we also had quite a bit of bullish volume, which that's interesting. When that comes after a long period of upward moves, it could signal some overextension and a potential pullback a little bit. But since we just had the interest rate decrease, I'm seeing excess volume on Thursday and Friday. It may not mean that. It just may mean that new money is coming into the market that was waiting for it. We have other indicators on here, which I will not take the time to explain right now, but you can always jump on my Zoom calendar and I'll go through it one by one. But basically, these are different indicators that are looking at momentum and volume, because those are the two most accurate, most predictive, least lagging indicators out of the 150, 200 different indicators, and then 1,000 variations of them that we have. So we're always looking at volume and momentum. Those are critical. I'll always talk about those. And then you see these straight blue and middle red lines. That's called a linear regression. And as long as we're inside the top and the bottom of the linear regression, we don't even notice it because that's just a safe zone. If it moves outside of the top, for instance, it generally comes right back in. So if it moved outside, we would consider that to be a top and we would be expecting a pullback. But everything looks good on the daily. On the weekly chart, same thing. We have finally broken through this blue band, which was a level of resistance, and a level of resistance is like a roof that the market's trying to break through. You can see back here there was a roof or a level of resistance. Market went up to it and failed. It went up, came back, it went up, it came back. It's hard to see, but it went up one more time before it failed. It just couldn't break that rooftop or resistance level until it broke it here. And then we went a little bit sideways, and now we have finally broken this one up here. These are really bullish signs. These are really bullish signs. So again, everything looks good to me. It continues. I said this last week, and we had another good week, but it continues to look good. We've been doing a lot of trading. So if you are one of my stock trading clients, you have seen a lot of trades, and that's because I'm taking profits off the table when I get them. So one of the most recent, we've had so many, was I went into, let's see if this will show me. Yeah, it's hard to see, but it says entry right down there. I went into a stock called MU based on my indicators, and you can see it was just breaking this level of resistance. We went in right here. It immediately shot up and hit our first profit target, and it even exceeded it. And when it hit this area here, I sold 50% of our position. Why did I do that? Well, we exceeded our first profit target and we went right up to a level of resistance. And I don't know if level of resistance is going to, like here, turn the stock around and push it back down. So I sold 50%. It didn't come down and it jumped up to our next profit level and I sold the rest. Or I think I sold 50% of the balance, which would have left 25%. And then today we had another good run and I sold the balance. So you're seeing a lot of trading. This is just one example, and you've seen four trades, an entry trade, a first sell, a second sell. I think there was a third sell and then the balance. But the point is, you've seen a lot of trading. And that is a style that we're going to do for now, for the time being, because I'm having a hard time trusting our economy and I'm having a hard time trusting what's going on with tariffs. There's just a lot of there's upheaval. There's political upheaval, obviously, in the country. There's geopolitical upheaval around the world. There's a lot of stuff going on. Now, there's always stuff going on, but it does seem heightened right now. So an old mentor of mine had a phrase that he used to always use. He said, see profit, take profit. And what he meant was, he doesn't mean if it goes up 1%, you're in profit, get out. But what it means is we're not letting most of these stocks run. I mean, this stock theoretically could go up 50% or 60%. We may have made, I'd have to look at the charts, but we may have made 15% or 20%. I don't know what we've made, but we had a decent profit. And when we do that, we're going to take it off. We're going to take it off the table, put it in the bank, which is your bank, until things calm down a little bit more. You never go broke taking profits. Never. You never go broke taking profits. So that's why we're trading a little bit shorter term. But if you look at your account values, they've been doing rather well. So that means we're picking good stocks. We're managing them well on the downside because not every stock goes up. And we're grabbing profits on the upside. And we've been doing that. And as you know, I've been working unbelievably hard, working with comparing different AI models, spreadsheeting everything. It literally takes an extra 20 hours a week to get that done. And I intend to do that for probably the remainder of this year. That will give us insights that will allow us to be even better than we are today. That's the goal. That's why all of that work is worth it. So I'm going to leave it with that. I don't want to take up too much of your time on your weekend. But if you have any questions, shoot me an email and never, ever feel bad about clicking on this button, which will take you right to my calendar and it'll schedule a Zoom call so we can talk about anything you want, any questions you have, or just send me an email. And again, this button will always take you to the weekly market analysis. That's a story. Have a great weekend. And I will be working this weekend again, which is fine. And then we'll get back together on Monday morning to do some more trades. Okay? Talk to you then. Bye bye.